Hello friends, welcome to the 36th episode of the Educative series of Ramkumar. This episode will be on the commentary of IPO of Patel Chem Specialities Ltd. This company will be listed in the SME segment of BSE. The RTA for this company is MUFG in time registry limited private limited. This issue opens on 25th of July and closes on 29th of July. As far as disclaimer goes, I am currently not registered with any regulator in India like RBI, SEBI, IRDA, etc. The remaining part of the disclaimer you can read at leisure on the screen in front of you. Now we can go into the complete issue details. It's, as we mentioned earlier, it's open from 25 July to 29 July 2025. The anchor investment portion will be subscribed to on 24 July 2025. The total issue size is 70 lakh shares of rupees 10 each. The minimum allotment would be 1600 shares, while for application we need to apply for a minimum of 3200 shares. This is a book building issue with the price ranging from 82 to 84, the lower cutoff being 82 or the floor price being 82 and the upper cutoff being 84. If you look at it in terms of the investment at the time of application, it would be 2,62,400 at the lower cutoff price and 2,68,800 at the upper cutoff price. There is no employee reservation in this IPO. Now I'll talk about a little bit about the company. The registered office and the corporate office of the company is located in Ahmedabad, which is in Gujarat. The BRLM, that is Book Running Lead Manager for this company, is Cumulative Capital Private Limited and Unistone Capital Private Limited. These two entities also are the underwriters for this particular issue. The market maker for this issue is Global Worth Securities Limited. This company was founded in 2008. They are into the business of producing or manufacturing high quality cellulose based excipients, which is generally used in the pharma industry, nutraceutical industry, food and beverages industry and others. The company exports outside of India to 15 other countries. However, the total sales or revenue coming from India is quite high. So in 23 it was 89.88%. So you can see almost 90%. In 24 it was 86.17%. In 25 it was 82.8%. The remaining contributed by the remaining 15 countries, as we mentioned earlier. As far as objects of this IPO is concerned, the IPO is being released for incurring capital expenses. The capital expenses will be used towards setting up facility in Indrar, which is a place in Mehsana in Gujarat, and for the general corporate expenses. If you look at it in terms of conflict of interest, yes, there is a conflict of interest, as the promoter, one of the promoters, is also trader of the finished goods of the company. To that extent, there could be issue with respect to the end price that the company derives in case of issues with the promoter. If you look at the capital utilization of the company, as we see, it is underutilized. In 23 it was 44%, in 24 it was 79%, in 25 it has reached a healthy 90%. Still it is underutilized. So the company has got some scope for improvement in terms of bringing it to full capacity and thereby increasing the business. Now the IPO proceeds itself will be used by the company for the objects so specified. As per the existing rules, they are supposed to appoint a monitoring agency. They have chosen to appoint Infomerics Valuations and Ratings Limited as the agency to monitor the outflow of funds received through the IPO. If you look at it in terms of the financials, we will look at the same 3 years, that is 23, 24 and 25 for revenue, profit and total assets. Revenue at 69.4 crores, followed by 82.3 crores, followed by 105.09 crores. So if you look at it in terms of last 2 years, the increase of revenue is almost double, or maybe 80-90% as compared to 23. If you look at it in terms of profit, it is 2.89 crores followed by 7.66 crores followed by 10.58 crores. So here again the companies got 4.5 times increase in terms of the profit over the last 3 years. If you look at the assets, the total assets, in 23 it was 37.08 crores followed by 46.96 crores followed by 65.31 crores. So in terms of assets, it's about 60-70% increase. If you look at it, the EPS, the diluted EPS being considered over a period of 3 years using the usual formula, then it is 4.83 rupees. If you calculate the PE ratio based on the lower cutoff and upper cutoff, you will get a value of 16.97 at the lower cutoff and 17.38 at the upper cutoff. Now I'll talk about the various factors that affect or would affect the working of the company. We will take the 4 items together, that is government, regulatory, policies, taxes and tariff. Any changes in the government due to political changes or policy changes or regulatory changes brought about because of acts or laws passed which could affect this industry or the land in which this industry is located in, etc., could create pressures on the maintainability of the profit as is predicted or mentioned in the prospectus. As far as taxes and tariffs are concerned, the company has not received any special tax for the facilities that they are operating from presently, or they are going to procure in that new location as mentioned in the prospectus. Tariffs would affect the company to the extent of only about 20% or so if you look at the 2025 figures, since the tariffs are generally adopted by the country where the goods are received. So here it will be those 15 countries which contributed to about 20% of the revenue in the year 2025. If you look at it in terms of revenue breakup, the top 10 suppliers of raw materials to this company contribute to 62.42% in 23, followed by 66.47%, followed by 57.76% in 25. So the top 10 suppliers contribute to almost 58%, which is not very good in terms of concentration risk point of view. Another important factor that we need to remember or take note of is that the imports are mainly from China, and because of the existing turmoil between India, US, China and other countries, there could be issues with respect to smoothness of import if in case the raw materials that is being imported from China were to be affected because of these taxes and tariff being played out by these countries. Internally, if you go to see, that is within India, majority of the raw materials are procured from Gujarat, Maharashtra and Delhi. So if there is any law that is changed in any of these countries, or any taxes being introduced by any of these countries, taxes, cess, VAT, etc., there could be issues with respect to the availability or smooth availability of the raw materials. If you look at it from the point of view of customers, that is the people to whom the finished products are being sold, the top 3 states are Gujarat, Maharashtra and West Bengal, which contribute to 64.72% in 23, followed by 60.74% in 24 and 65.97% in 25. So about 66% of the revenue is collected from these 3 states, which again is a concentration risk, as any changes of law or act in these 3 states or one of these 3 states could create an impact in the earnability of revenue. The factory that is presently operational is on lease. So to that extent, of course, the lease is being continued since quite some time, but there is always a risk of the lease being terminated or for some reason not being continued with. In that case, the company will have an issue in terms of shifting the operations and hence maintain the continuity of operations. If you look at the cash flow, it is negative cash flow. So continuous negative cash flow would create pressure on the ability to make profits. So the company should be able to come out of this negative cash flow quickly. If you look at loans, they have taken secured loans, which may create impact only if it is called by the entity which is given these loans. We'll take up operations and quality together. Since this company is into important industry, failure to maintain quality could create huge issues in terms of insurance, in terms of complaints and litigations against the company. So the company has to ensure the operations are smooth running and quality of standard quality is maintained. If you look at it, insurance, the company claims that the insurance for the current year or as we speak or as is mentioned in the prospectus is good. However, since it is being reviewed periodically, there could be times when the insurance is less or the company is underinsured. This could be an issue if there is some eventuality when the underinsurance is in operation, as the company may not be able to get the full benefit of the insurance being taken, thereby having to let go of their purse strings and pay money, thereby decreasing the profits. If you look at agreements, there are no long-term agreements with the suppliers. This is not to be confused with the rent agreement or lease agreement. This is basically agreement with the suppliers to supply the finished goods. Now, if you look at the non-compliances, there are quite a few non-compliances with ROC, that is forms related to Companies Act having to be filed with ROC, that is Register of Companies, between July 24 and November 24. Similarly, for ESIC, there were 2 observations. Of course, there are no penalty levied. GST, there were 3 observations. The company has mentioned that these non-compliances will be handled by way of internal controls, training, etc., which seems to have been true from November 24 onwards. We have summarized the RHP and placed it to you for your perusal. This is meant to be purely an educational exercise to make the viewer aware of the pros and cons of the financials and the strengths and weaknesses of the company. In light of the above, there is no reference to the correctness or otherwise of the price on offer, prevailing grey market price, possibility of listing day earnings, etc. Should you find this video informative and educative, kindly pass it on to your friends and relatives. Please press on the like button and subscribe to this channel. Should you have any doubts, queries or suggestions, kindly contact me at ramkbharosay@gmail.com. Thanks.